Let's resume, guys. Yes. Okay, sir, let's resume. So we were discussing this definition of financial liability. I hope you are clear, absolutely clear till here. Right? Debentures issued. Now I want to discuss a few important points with you as well. Let's say, for example, company issues, not debentures, but company issues own equity shares. Issues own equity shares. Right? The company issues own equity shares. Under this, do they promise the holders that they will certainly receive dividends? No. Dividends will be paid only when there are profits in the company. Otherwise, they won't pay. Acha, do the company promise the shareholders that the principal will be repaid after a certain number of years? No. The principal, either the holders can recover by selling the shares, or the company will repay the principal only upon liquidation. So here there is no obligation on the company to deliver anything. Right? Because the ones who invest in the equity shares of the company, they become the owners of the company. But I'm not talking from the point of view of investor. Now I'm talking from the point of view of the company who issues the equity shares. Right? So for the company who issues the equity shares, never call this a financial liability. It will always be a equity. It will always be a equity. That is why if you see, whenever company issues equity shares, they are shown on the equity side. They are shown on the equity side of the balance sheet. See, in balance sheet, there are two sides, asset side and the opposite is liability and equity side. So asset side, there is only one thing, assets. Under the opposite side, there are equities also, there are liabilities also, right? So the equity share capital which is issued will not be shown under the liabilities head. First, it has to be liability, then we will think whether it is a financial liability or not. But when you issue equity shares, when you issue your own equity shares, for the issuer, it is a equity transaction. So it will come under equity share capital. Do you remember this point? So just remember, when you issue, please remember, always there are two parties to a transaction. I'm not talking from the point of view of the person who will buy the shares. I'm talking from the point of view of person who will issue the shares. For example, Reliance company issued shares. I bought the shares. I'm the investor. I'm not talking from the point of view of investor. I'm talking from the point of view of the company who is issuing the shares. Okay? Yes. Kishan, I'm not discussing about that. Kishan is saying that, sir, but when the application money is paid but no enrollment, then refund. I'm not talking about that part. I'm saying that the company issues shares. Right, the company will receive the money from the equity shareholders. What will happen when the application money is to be refunded? That I'm not discussing. I'm discussing a basic equity share issue. Okay, yeah. Because first we need to understand the basics now. Then we can discuss advanced things. First, if you think about the advanced things, then the basic won't get very much clear, right? Okay, anyways. So I guess you understood this. So remember, when the company is issuing own equity shares, it is a equity transaction, not a financial liability. Okay, sir, got this. Let's continue further. Point number 8. Let's say company issued convertible debentures. Convertible debentures issued. Convertible debentures issued. Okay. Again, talking from the point of view of issuer, the one who issues convertible debentures. Now these are convertible debentures. Under convertible debentures, let's say company issued this debenture for a period of 5 years. Okay, so company will have to pay interest. I am saying ignore this part as of now. Ignore the interest part. Ignore this. Sir, why? I will talk about this later on. Let's just talk about the principal part. When the company who issues convertible debentures, they have to repay the principal also. But because they are convertible, will the company give cash? No. What will the company give? Company will give equity shares. That also own equity shares. Let's say, for example, Reliance company issued convertible debentures. So when the principal repayment is to be done, Reliance will give their own equity shares to the holders. Reliance will give their own equity shares to the holders. Now let's evaluate whether giving equity shares is a financial liability or not. We have to check this. Whether giving equity shares, whether issuing own equity shares is a financial liability or not. Let's check. Is there a contractual obligation to deliver cash? I already said ignore the interest part. Just talk about the principal. Is there a contractual obligation to deliver cash? No, sir. Because in principle, the company is not giving cash. Okay. Is there a contractual obligation to deliver any other financial asset? is there a contractual obligation to deliver any other financial asset? So you will say, yes, sir, giving equity shares can fall here. The answer is no. It will not fall under A2 also. It will not fall under A2 also. I'll tell you why. When we say contractual obligation to deliver any other financial asset, first see whether issuing own equity shares is a financial asset or not, right? Whether giving your own shares is a financial asset or not. It is not a financial asset. Why? When will you say that you have an obligation to give financial asset? When? What comes under financial asset? Now this is a little deep discussion, okay? So you will have to give me a couple of minutes for you to understand this point, okay? Just remember, whenever the company says financial asset, what all comprises of financial asset? Cash is a financial asset. Equity instruments of another entity is a financial asset. Equity instruments of another entity is a financial asset, right? When the Reliance company says it is going to give own equity shares for against principal, when the issuer says they are going to give own equity shares, giving own equity share cannot be treated like a financial asset. Giving own equity share cannot be treated like a financial asset. Why? Any company cannot hold their own equity shares. They can only hold other companies' shares. Sir, why? Do you remember buyback? We used to do buyback in Z Enter. Whenever a company buybacks its own shares, they have to cancel them off within 7 days. Why? Because the company is not allowed to hold its own shares, because that will lead to insider trading, right? Because the company will come to know whether it is performing good or not. So that will lead to insider trading, right? So don't ever say that issuing own equity shares is a financial asset. Why? Because holding own shares is not allowed. So it cannot come under point number A2. You cannot say that under point number A2 we are saying contractual obligation to deliver any other financial asset. Giving your own equity share does not mean that you have an obligation to deliver financial asset. Own equity shares are not financial asset. So where will this point lie, sir? It is just like, can I say you are going to issue own equity shares? Can I say you are going to issue own equity shares? Not directly, but in the principal repayment after 5 years. You are going to issue own equity shares, not directly, but after certain number of years against the principal repayment. So perfect answer, Supraja. This is not a financial liability. Just trying to explain you through this whole discussion that this is an equity transaction. That means from this you should take one thing at home. That one thing is going to be whenever the company has to give own equity shares. I am talking from the point of view of giver, not from the point of view of holder. Not talking from the point of view of investor. I am talking from the point of view of issuer. Whenever the issuer has to give own equity shares, it can be a direct issue or it can be an issue under conversion. Whenever company has to give own equity shares, it is a equity transaction. Do remember this point. It is a equity transaction. So that means if you look closely, so debenture will come under equity? So debenture will come under equity? Yes, it can. If they were normal debentures, normal debentures, then they will be financial liability. If they are convertible debenture, then they are equity. Now remember a childhood. Childhood means your 11th, 12th foundation, right? In childhood, what we used to read, we were taught that this is your balance sheet, right? This is your, let's say, liability side. We were taught that this is your share capital. Under share capital, you will write equity share capital, preference share capital. Talking about AS, childhood means AS. We were taught this, right? This was your equity head. And then under the liabilities head, always there will be certain 10% debentures or something. But these rules have been broken down by Ind AS. Ind AS never says that preference are equity or debenture are liability. Ind AS says, look at the contract. If these debentures are convertible, these debentures are equity. Because ultimately, under conversion, you have to give own equity shares. If these debentures are normal debentures, this is a financial liability. Same discussion will be done also for preference shares. I will do it later on. Preference shares can also be a liability. They can also be equity. That means from now onwards, under Ind AS, if anyone will ask you whether debenture is a liability, so do not directly say yes or no. First ask him whether they are normal debentures or convertible debentures. If anyone will tell you that preference will 100% come in equity, tell them no. We'll have to check the contract, whether it is a normal preference share or convertible preference share. So that means, sir, we were taught wrong things in AS. No, as per AS, this is correct. But as per Ind AS, this is not correct. So forget your childhood from today onwards. Whatever you were taught in AS was a myth. in this financial instrument says tata bye bye to all those concepts. Okay? Yeah. Understood, sir. Okay. Don't worry. If you understood this, I will also give you more examples just for clarification purpose. Don't worry about it. Okay? Chalo. Let's write certain more examples so that I can come to know. Acha, tell me one thing. Did you understand this first? Under principle, if you are giving own equity shares, or just remember, in liability, whenever you are giving own equity shares, not a liability, it is a equity. Simple. Okay? Chalo. Understood now? Great. Let's say we have convertible preference shares. Let's say we have convertible preference shares. Again, under preference, instead of interest, you give dividend. As of now, ignore this part. As of now, ignore the dividend. We don't know what dividend is. Because this is convertible, under principle, whenever the conversion happens, for principal, company will give own equity shares. Now tell me, will it be a financial liability or equity? Or neither of them? Will it be a financial liability, normal liability, or equity? Perfect answer, it will be a equity. I guess you have understood this very clearly. So I guess you have taken one thing from this. Whenever we want to issue own equity shares, it is an equity transaction. Simple. Very good. Right? Guys, done now? Perfect. Chalo, ठीक है. Acha, let's take the example further. Let's say the company issued normal preference shares. Let's say the company issued normal preference shares. Normal means they are not convertible. They are normal preference shares. Normal means the company who issued will have to give dividend in cash during the tenure. And the company who issued will also have to repay the principal in cash at the end of the tenure. Normal, you can say, preference share issued. Tell me, where will this preference shares be classified? For dividend, company will give cash. Preference shares means just like debenture only, issuing an instrument to raise funds for a certain number of years. So dividend will be given in cash. Normal preference shares, the principal will also be given in cash. Very good, Ajay Subraja. Very good, everyone. It will nothing but be a financial liability as per point number A1. Why? Contractual obligation to deliver cash. Can you clearly see? Preference share can also be equity. Preference shares can also be FL, liability. Can you clearly see? Debenture can be liability. Debenture can be equity also. Substance over form. Can you see the depth of Ind AS? Great. Perfect. Chalo. So from now onwards, you know where to classify each and everything. Okay. Chalo. Let's proceed further. 11th point. Let's say I have a trade payable. Let's say I have a trade payable. So normally I give cash to trade payable. Normally I give cash to trade payable. But I said I will not give cash to him. I said I will give bills receivable to my trade payables. I will give bills receivable. That means to my financial liability, I am giving a financial asset. Is this a financial asset? Yes. So that means I am giving a financial asset to my financial liability. I am giving a financial asset to my financial liability. So, am I giving cash? No. So there is no contractual obligation to deliver cash. No, I'm not going to give cash. But there is an obligation to deliver any other financial asset. Is bills receivable a financial asset apart from cash? Yes, bills receivable is a financial asset. Bills is a financial asset, right? So I am giving my financial liability a financial asset. Perfect answer. Then these trade payables will be financial liability as per point number 8.2. So when you are going to give your financial liability, not cash, but any other financial asset, still this trade receivable will fall under the head of financial liability only, but as per point number 8.2. Just for an example, just remember this, not very important. Not very important means not very critical from exam testability point of view, but yes, we should know each and every example of each and every point. That is more important. Okay, I guess you understood this. Let's proceed. 12th. Like in financial asset, we had income tax refund. Here we have income tax payable. Tell me whether a financial liability or not. Now you should be able to tell me this. Income tax payable, whether it is a financial liability or not. Very good answer, guys. Never say it is a financial liability or not. Just say it is a not a contractual but a statutory obligation. So we can simply say na not in scope of financial instruments. This is not in scope of financial instrument. Very good answer. Yes. Acha. One more thing. 13 point. Let's suppose you have any provisions for gratuity, provision for bad debts, or any other provision. Provision for bad debts, gratuity, any other provision if you have. If you have any kinds of provisions, these are also out of scope. These are covered under Ind AS 37. Right? So again, not a financial liability. Also under provision, there is no contractual obligation to deliver anything. Okay. So these are not a financial liability covered under Ind AS 37. Just remember this point. 14 point. One more thing was there. Security deposit accepted. Now what is the meaning of the point accepted, sir? Accepted simply means, see for example, when a tenant gives deposit to the owner, there are two parties now. So for the giver, it is a security deposit given a financial asset. For the owner who is receiving that deposit on day one, it is a liability for him. Tell me whether it is a financial liability for him or not. For this owner who is accepting the deposit, it is a liability. But tell me whether it is a financial liability or not. Perfect answer, yes, it is a financial liability. Why? Because the owner who is accepting the deposit on day one will have to refund the same at the end of the contract. So contractual obligation to deliver cash. Very good. Yes. For the giver, if it was a financial asset, for the receiver on day one, it will be a financial liability. Nah, baba. It is obvious. Okay. So I guess these many examples are more than sufficient for you to understand this point of financial liability. Right? I have taught you what is financial asset. I have taught you what is financial liability. And inherently, I also taught you what is equity. So what is equity, sir? Whenever the issuer is going to give its own equity shares by way of new issue, under conversion, whenever they are going to give own equity shares, let's say for example BB Virtual is going to give equity shares to the professors. So for BB Virtual, such issue of equity shares is a equity transaction. So whenever a company is giving its own equity shares, it is not a liability, it is a equity transaction. Right? Again, I am telling that I am not talking from the point of view of the person who is receiving the shares. I am talking from the point of view of the person who is issuing the shares. For the receiver, it is a equity instrument of another entity. It is a financial asset for the receiver. For the giver, it is a issue of own equity shares. So it is equity transaction. So for OFU purpose, I will make you write something. You can write OFU. Because the formal definition I will give later on for equity. Just write OFU. Own equity shares. Own equity shares deliver. It is an equity transaction. When you are going to deliver own equity shares, it is equity. Right? Done, sir. We are done till here. Okay. Chalo. Again, financial liability. Giving you a couple of minutes. Even the recorded ones, you will pause and read. The live ones, again, giving you a couple of minutes. You will have to read the definition. I know point number B and C are pending. That is fine. Read the definition and read the examples. Okay. Time starts now. Giving you a couple of minutes. If you have any query, you can ask me. Perfect. Start. Done reading, guys? Okay. Now let me introduce to a new concept. And that is compound financial instruments. What is the name, sir? Compound financial instruments. So what is this? Compound financial instrument? Don't worry. Wait, have some patience. In Hindi we say ruko jara, sabar karo. That means wait, have some patience. Right? Just give the heading compound financial instruments. Now this is going to get very interesting now. Let's assume, what is the meaning of this? Just leave 2 lines here. And let's discuss one instrument. Let's say we have a debenture. Now please remember, I'm talking from the point of view of issuer. Issuer means the company who is raising the funds. So either for the issuer, it will be a liability or equity. It cannot be asset for the issuer, right? Either it will be a liability or equity. If it is a liability, then it will be either a normal liability or a financial liability, right? That is what we are checking now. So let's say there is a debenture. So debenture are of 2 types. One is a normal debenture where you raise the funds. Interest repayment has to be done in cash. Principal repayment has to be done in cash. That is known as redeemable debenture. That is known as redeemable debenture. So under redeemable debenture, it means normal debenture. You raise the funds on day one. You make the interest payment in cash every year. You make the principal payment in cash every year. Right? So here, the interest payment will be done in cash. So is it a financial liability? Yes, sir. Achha. What about principal payment? Will it be done in cash? Yes, sir. So will it be a financial liability? Yes, sir. Contractual obligation to deliver cash. Okay. Okay, sir. Simple. So this is the redeemable debenture, as we say. The second kind of debenture is convertible debenture. And just to be very clear, it is a compulsory convertible debenture. That means against principal, compulsorily the company will issue own equity shares. The company will issue own equity shares against principal. But every instrument has 2 kinds of repayment. Even in the convertible debenture case, company has to make the interest payment. No? Suppose the company issued convertible debenture for 5 years. So during these 5 years, the company will make the interest repayment. This interest repayment will be done in cash only. Will be done in cash only. So tell me, when the company will give cash against the interest payment, delivering obligation to deliver cash is a financial liability? Yes, sir. It is a financial liability. But under principal payment, is the company going to give cash? The answer is no. Because it is a convertible instrument, company will give own equity shares. Company will give own equity shares. This principal part of the instrument, will it be a financial liability or will it be a equity? Time starts now. Please answer. Again asking, this principal part of the instrument where you are going to give own equity shares, will this be a financial liability or will this be equity? Perfect answer, sir. This will be a equity. Because beforehand only you told, whenever the company is going to issue own equity shares directly or under conversion, they are known as equity. So the principal part of this instrument is going to be equity. Very good answer. Now, can you see a single instrument has one part as financial liability and one part as equity? Has one part as financial liability. There is a single instrument. Single instrument has 2 parts, interest and principal. the interest part of this same instrument is FL, and the principal part of this same instrument is equity. Whenever an instrument has both components, FL and equity, in a single item, whenever a single instrument has both components, FL and equity, such instruments are known as compound financial instrument. In short, I can call them as CFI, compound financial instrument. So what is the meaning of compound financial instrument, sir? A single instrument where it has both the elements, element of FL and element of equity. Both tadkas are there in this. When you have both the crackers, both the patakas mean crackers, both crackers, FL cracker and equity cracker both. Cracker means patakas, okay. Firecrackers. So when you have both the elements, it is known as CFI. Acha, tell me one thing. That means this compulsory convertible instrument was a CFI because interest was FL, principal was equity. Tell me this one. This instrument, redeemable instrument, where the interest was also made in cash, principal payment was also made in cash. Is this a CFI? Is this instrument a CFI? Yes or no? That is my question. Is this instrument a CFI? Perfect answer. The answer is no, na? Because when will you call it a CFI? When it has both elements, FL and equity elements both. Now I can define CFI. What is the meaning of CFI? It means a single instrument which has FL plus equity. A single instrument which has FL plus equity. Right, guys? Yes. So understood this. Simple. Simple, simple. Simple, simple. Claps for me. Yeah. Chalo. To make things more, make you understand things more in a much better way. Chalo. Let me give you one more example. Let's say we have preference shares. Let's say we have preference shares. Similar discussion can be done for preference shares also. Okay. So let's say we have preference shares. They can be of two types. Either they are redeemable or either they are convertible. Under convertible also, compulsory convertible. Achha. In preference shares, if they are redeemable, you will give dividend. Instead of interest, we give dividend. Achha. One thing, in case of debenture, the interest payment is mandatory for the company raising the funds. They have to make the interest payment. What about preference share? Is the dividend mandatory? So if you will say yes, sir. No, it depends on the contract between the issuer and the investor. Dividends can be discretionary also. They can be mandatory also, right? So I will just write it down. Dividends can be discretionary also. Discretionary means if the company have the funds, they have the relevant profits, then only they will give. Otherwise, it can be mandatory also. Sir, how we will come to know in exam? In exam, if nothing is mentioned, we will always assume it to be mandatory. Assume this if nothing mentioned. If nothing is mentioned, of course, we will assume it to be mandatory. Na? If it is discretionary, it will be specifically mentioned. Okay, because preference share is such of a nature where the company raises funds and they are giving dividend at a fixed rate. So nothing is mentioned, we will assume mandatory. But if it specifically said it was discretionary, okay then. Okay. But what if it was discretionary, sir? So when the dividend is discretionary, that means the company will pay only when they have funds, only when they have profits. So when the dividends are discretionary, can I say there is no obligation on the company to pay the dividend? Because when we talk about financial liability, financial liability clearly says there should be an obligation to deliver cash. When the dividends are discretionary, can I say the obligation is avoided? There is no obligation because we will distribute the dividend only when we have profit. We will distribute the dividend only when we have profit. So the obligation is no more valid in this case. So just write in the brackets, when the dividend is discretionary, there is no obligation. So just write, we will distribute only if company earns profits. We will distribute only if company earns profits. So very good answer, Supraja. In this case, it is not a financial liability. Then what will it be called? We will discuss that later on. But when the dividend is mandatory, of course, the payment of dividend will be a financial liability, because when it is mandatory, you will pay in cash. So of course, it is a financial liability. Okay. Just to be clear, in maximum questions, when nothing is mentioned, always assume it to be mandatory. This is just for clarification purpose. By chance, if in 1 or 2 questions you see that it is not mandatory, it is written specifically that it is discretionary, then we will say it is not a financial liability. That we will discuss in the question only. As of now, you can forget this. As of now, just remember dividend is mandatory. Okay. So mandatory dividend, financial liability. And now because the instrument is redeemable, so principal also has to be paid in cash. So the principal payment will also has to be made in cash. So interest in cash, principal in cash. So FL. So of course, if both the elements are FL, then it is not normal instrument, not a CFI. It is a normal instrument because both the elements are FL. I'm forgetting this part as of now. Okay. Let's come towards the second part. This one. Let's come here, where we say the preference shares are convertible but compulsory convertible. Now let's see how much you have understood. I will come to know from here only. When they are compulsory convertible, still the company will have to make the dividend payment, which is of course mandatory. For principal, because it is compulsory convertible, you guys all know now, the company will give own equity shares for principal, but for dividend, mandatory payment has to be made in cash. Answer both these elements and tell me whether this is a CFI or not. CFI, yes or no? Tell me this. Time starts now. Convertible, I gave you maximum hints. Okay, dividend is mandatory. That means during the tenure of the instrument, you have to give cash for dividend, right? And principal, because it is compulsory convertible, under principal, the company will give own equity shares. Tell me. Very good answer, everyone. This dividend element will be FL. This principal element will be equity. So if in single instrument you have FL as well as equity, then it is a CFI. Very good answer, guys. Highly impressed. Very good. Chalo, let's proceed. Let's proceed further, sir. Okay. Let's proceed further. Chalo, let's do some more advanced discussion as of now. Let's say, again, I'm talking from the point of view of issuer. Let's say now we have a debenture. Which is convertible. Okay. Just to be clear, it is convertible debenture. Now, under convertible debenture, it is not compulsory convertible. The conversion is optional. Who has the option, sir? Let's assume. See, we are issuer. Okay, we are the issuer of this debenture. Conversion is optional. Let's take 2 cases. First case, conversion at the option of the holder. The holder will decide whether the holder wants to convert it into cash or the holder wants equity share for the same. Okay, holder will decide. Unlike the previous case where it was compulsory convertible. No, it is not compulsory convertible. The holder means who? The investor will decide whether during the principal repayment he wants cash or he wants shares, and he will decide at the end of the tenure, not today. On day 1 he won't tell his preference. He will tell the preference after 5 years, let's say. So conversion is at the option of the holder. Now the question is, the simple part, interest has to be paid in cash. This element will be FL. Everyone knows this. What about the principal component? We have to define the principal component on day 1. But on day 1, we don't know what the holder will choose. See, we want to tell the financials on day 1 itself whether this principal will be FL or equity. If the principal will be redeemed in cash, it will be FL. If it will be redeemed in equity shares, it will be equity. But on day one, we don't know now what the holder will choose. Tell me, how do we classify this principal? Now, for this issue, what the standard says is, you are the issuer, right? Can the issuer, at its own will, avoid paying cash? That is my question. Can the issuer, at its own will, avoid paying cash? Can the issuer refuse the holder to pay cash if the holder demands for it? If the holder demands for cash, holder can demand anything. Holder can demand cash also, holder can demand shares also. But that is not the case. We don't know what he will demand. But the question is, can the issuer refuse to pay cash if the holder demands for it? The answer is no. Issuer at its own will cannot avoid paying cash. If the holder says I want cash, issuer will have to give cash. If the holder says he wants shares, issuer will have to give shares. That is fine. But can the issuer refuse to pay cash if holder wants it? The answer is no. That means you as an issuer have an obligation to deliver cash. You as an issuer have an obligation to deliver cash. I will just write this down. Under principle, I will write issuer at its own will cannot avoid paying cash. So you will treat this like a financial liability, irrespective of what the holder might ask at the end. We don't know what he might ask at the end of 5 years. But on day one, we have to define it as a equity or FL. You will call this as a FL. Because you are the issuer, you don't have the option to refuse. You don't have the option to refuse to pay cash. So it will be a FL for you. If you want to understand this in a better way, let's suppose this issuer is a husband. Okay, I will give you an example which is relatable to you. Suppose this issuer is a husband or a boyfriend and this holder is a wife. Now tell me one thing. If the wife says she wants to go to shopping, can the husband refuse? The answer is no. That means husband has a liability, financial liability. See, wife can refuse. Wife can herself say that she doesn't feel like going to shopping. That is husband's benefit. That is fine. But if the wife says that she wants to go for shopping, can the husband refuse? The answer is no, sir. That means husband will always have a financial liability. Wife, of course, at a later stage might refuse. That is fine. That is option with the wife. But can the husband refuse? The answer is no. Issuer is like husband. If he cannot refuse, it is a financial liability for him. Understood, sir. Chalo, let's proceed further. Now we understood, sir. Chalo. Conversion. Now, what if the conversion option was with the issuer? Conversion at the option of the issuer. Now, issuer himself, husband himself has the option to refuse. Acha. Tell me one thing. Interest, of course, has to be paid in cash. There is no option here. It is a FL. Now, I'll talk about principal. Right. Again, I'll ask the same question. Issuer has the option of conversion. That means issuer will decide whether he wants to pay cash or equity shares. He will decide at the end of the tenure. On day one, we don't know what he will pay. But today, if we ask the issuer, can the issuer at its own will avoid the cash payment? He can pay cash, he can pay shares. That is fine. He can give shares. But can the issuer at its own will avoid paying cash here? When the option is with the issuer, when the option of going to shopping is with the husband, can the husband at its own will refuse? Yes, sir. He can refuse. If the principal, he can refuse, na yaar? Can I say issuer here? Husband will definitely refuse. Can the issuer at its own will? Here, yes. Issuer at its own will, I can say, can avoid paying cash. Can avoid paying cash. So we will call this, when the cash is avoidable, it is not a financial liability anymore. So it will be a equity. Again, just to clarify, what will actually happen, we don't know on day one. That we will come to know at the end of 5th year. So, sir, what we will do at that time, not to be discussed now. But we have to make this classification on day one. We have to tell them on day one whether it is a FL or whether this is a equity, right? So just remember, when we are talking from the point of view of issuer, let me simplify things for you. When we are talking from the point of view of issuer, if issuer has the option, then it is not a liability for him. But if issuer does not have the option, it is a liability for him. Simple. Talking only from the point of view of issuer. Okay. So of course, in the second case, the instrument has FL and equity both components, so it will be a CFI. But in the first case, because both the components were FL only, so will it be called as a CFI? The answer is no. The answer is no. Same logic, you can say same logic for preference as well. In preference also same logic. If it is a convertible preference share, see option is with whom. Okay, same logic I will write for preference share. Okay, yes. If you have understood this, you have written this. Okay, I will take a oral test now. Okay, you will not write anything, you will just answer me. Just keep your hand in the chat box, recorded once, you just answer it in your mind or on the paper. What is it? Okay, taking an oral test for you guys. Time starts now. Okay, just tell me. For example, there is a redeemable debenture. I want to know whether it is a CFI or not. CFI or not. I have a redeemable debenture. Of course, I am talking only from the point of view of issuer. Talking only from the point of view of issuer. Asking you whether it is a CFI or not. Time starts now. Please answer. Talking from the point of view of issuer, whether it is a CFI or not. Perfect answer. It is not a CFI. Not a CFI. Why? Always to check, just evaluate. How will you evaluate? Redeemable debenture. Interest to be paid in cash, so it is a FL. Principal redeemable, so principal to be paid in cash, again FL, not a CFI. Very good answer, guys. This is how we will do the oral test. Okay. There is a, let's say, preference share. Okay, in case of preference, always assume dividend to be mandatory if mentioned otherwise. Okay, so dividend mandatory. Preference share is there. Convertible. Okay, it is compulsory convertible. Just to be clear, compulsory convertible. Tell me whether CFI or not. Preference share is there. Compulsory convertible. Whether it is a CFI or not, assuming dividend is mandatory. Okay, mandatory dividend. CFI or not? Very good answer. It is a CFI. How come, sir? Because dividend, assume mandatory, FL. Principal, it is compulsory convertible. So no question of who has the option. Compulsory convertible, issue on equity shares. Yes, CFI. Thoda FL, thoda equity, little FL, little equity, CFI. Okay. Assume there is a debenture or preference share, any of it. It is convertible. Who has the option? Convertible at the option of the holder. Convertible at the option of the holder. Again, I'm talking in the books of issuer. How will issuer classify this? Debenture is convertible, convertible at the option of the holder. Tell me CFI or not. Tell me CFI or not. Very good answer. This is not a CFI. Sir, why? Why? Interest is FL. Principal. Holder has the option. Whether this person, this issuer, at its own will, can he avoid paying cash? The answer is no. That means if the issuer cannot avoid paying cash, for issuer it is a FL only. Issuer will always treat like the holder will demand cash and he cannot refuse at its own will. So both FL, not a CFI. Acha. Debenture. Convertible. Option of the issuer. Issuer has the option. Issuer has the option of conversion of debentures. Debentures are convertible. Issuer has the option. Tell me, whether will it be a CFI or not? Very good answer. It will be a CFI. Why? When issuer has the option, the interest has to be FL, but the principal, can the issuer at its own will avoid paying cash? Yes, issuer himself can refuse to pay cash, right? So when the cash payment is avoidable at the option of the issuer, there is no obligation. So if no obligation, then you will treat as equity. So, done with the oral test? Yes. Not very relevant. No need to write this. This is just already written above by you. Last point I will discuss, just take a couple of minutes and then we can wrap up the session. Okay, last point I'm discussing. CFI concept we discussed from whose point of view? We discussed only from issuer's point of view. Let's discuss from the holder's point of view. Holder means the investor. The investor who buys such convertible instruments. Okay. Let's say, for example, there is one holder, Mr. Ajay. He is the holder of the instrument. Okay. He invested in which company shares? Let's say he invested in compulsory convertible debentures of Reliance Company Limited. Mr. Ajay invested in compulsory convertible debentures of Reliance Company Limited. Now I want to know whether this instrument for holder will be a CFI or not. Let's see. Did you understand? I am talking from investor's point of view now. See, I was discussing now from issuer's point of view this whole instrument. Similar instrument, similar compulsory convertible debenture. Now I am discussing from the point of view of issuer. What will the issuer receive? One, he will receive interest. Interest he will receive in cash. Okay, so this is for issuer, it is not a financial, it is a financial asset. As per point number C1, do you remember contractual right to receive cash? Okay. And he will receive the principal. In what form? Compulsory convertible, so he will receive equity shares. For principal, he will receive equity shares of Reliance. Because Reliance will give, Reliance will say, I am converting my debentures, so I will give my own shares. So for Ajay, he is receiving equity shares of Reliance in principle. For Ajay, he is receiving equity shares of Reliance in principle. How will this principal be classified? By Ajay. How will this principal be classified by Ajay? Don't rush through things. Read it very carefully. In principle, Ajay is entitled to receive equity shares of another entity. So please don't make the mistake of calling this equity like a hucha. Arey, for investor, there is no equity. For investor, it will always be a normal asset or financial asset. So for investor, is it a financial asset? The answer is yes. How? Can I say for the investor? Just read the definition now. For the investor, under principle, he has a contractual right to receive equity instruments of another entity. Na? Very good answer, Suprajab, Kishan, Ajay, very good. Under principle, he has a see, for interest, he has a contractual right to receive cash. C1, financial asset. For principal, he has a contractual right to receive equity shares of another entity. For Ajay, Reliance is another entity, na? Right? So for holder, even receiving equity shares is a financial asset. Even receiving equity shares is a financial asset. For whom? For the holder. That means what I am telling you is this same instrument, if I was talking from the point of view of Reliance, it was a CFI. For Reliance, for the issuer, it was a CFI. Why? Interest in cash, FL. Principal in own equity shares, equity. So for the issuer, it might be a CFI. For holder, there is no concept of CFI. For holder, there is no concept of CFI. For holder, either it is a financial asset or a normal asset. Because in the asset side, there is no equity in column. Na? In the asset, there is only normal assets or financial asset. In the opposite side, we have equity and liabilities. Na? So the concept of CFI can only persist from the point of view of issuer. There is no CFI from the point of view of holder. Because for holder, it will always be a financial asset. Can you feel this concept of what I'm telling you? Maximum students, even after studying financial instruments for 5 times, they don't know this concept. They don't know that this concept of CFI can only be from the point of view of issuer. So I will make you write this now. Can you feel this? Tell me yes or no quickly. Yes. So let's write this now. Note. Compound financial instrument. I will say only applicable from the point of view of issuer. from the point of view of issuer, only applicable from the point of view of issuer. Okay, just write below for holder. For holder, there is no concept of CFI. For holder, only financial asset. Very good question, very good. For holder, only financial asset. This is the level of clarity you will be getting in this whole chapter. It is going to be very easy. I'm telling you, it is very easy. Just be patient to complete the full chapter with me. We will take a nice number of days, but that is fine. We will do it very nicely. Can you feel this? See, again I'll repeat. This compulsory convertible instrument, when we were talking about issuer, for issuer, interest was in cash, principal was in equity. So we told CFI. But for the investor, he will receive cash, he will receive shares of another company. Receiving shares of another company is also financial asset. Receiving cash is also financial asset. Unlike issuer. That is why. Okay, so just write this. You will, don't worry, you will understand once you revise everything. Okay, so let's revise everything once quickly and then we can wrap up the session. Okay, chalo. So let's start the revision in 3, 2, 1 and go. First of all, we started with this chapter of financial instruments, which has 3 indices, 32, 10 and 107. Okay, we discussed the definition of financial asset. There are mostly, we discussed only A, B, C. D is pending. We will discuss it tomorrow. A says cash. If you have cash, financial asset. If you have equity instruments of another entity, financial asset. If you have a contractual right to receive cash, financial asset. If you have a contractual right to receive equity shares of another entity, or if you have a contractual right to receive any other financial asset. Do you remember C3 also we discussed, when the trade receivable will give us bills receivable. So it is contractual right to receive any other financial asset. So covered here itself. Examples we discussed. Then we discussed for financial liability. B and C point we will discuss tomorrow. A we discussed. A1, contractual obligation to deliver cash, or contractual obligation to deliver any other financial asset is a financial liability. Also remember, when you have an obligation to deliver own equity shares, it is not a FL, it is a equity. Right? Okay. Last point was compound financial instrument, and instrument where you have both the elements, FL element as well as the equity element. Right? So let's say, for example, you have a debenture. If it is redeemable, both elements will be FL. It is not a CFI. If it is compulsory convertible, then the interest element is FL, but the principal element is equity, because you are going to give own equity shares, compulsory convertible. So now this is a CFI. Same is the case with preference shares. In preference shares, just see whether dividend is mandatory or discretionary. If mandatory, then normal logic applies. If discretionary, then you will not treat it as a financial liability. Okay, yes. And the last point, if the debenture is convertible, then just see who has the option of conversion. Just see who has the option of conversion. If the conversion option is with the holder, if the holder has the conversion option, in that case, the issuer at its own will cannot avoid paying cash, right? So it will be, both elements will be financial liability. But if the conversion option is with the issuer, then issuer at its own will can avoid paying cash. So the principal will be an equity element. Okay, then it will become a CFI. The last point, CFI element is only from the issuer's point of view. For holder, it will always be a financial asset. With this, we wrap up the session. I hope you enjoyed this session. Just one request: whenever you come tomorrow, please revise and come. If you're not revising tomorrow's lecture, you won't be able to understand. You have to revise it, and I will make sure you will revise it each and every day. Okay, so just the first part, just give a whole overview revision. It will hardly take 10 to 15 minutes. Just give that revision and then see how smoothly this whole chapter goes. Okay, so with that, thank you so much. I will wrap up the session. Bye bye everyone. Take care. See you all. Bye bye. See you. Bye bye.